Are we live, Ravi?
Yes, we can start now.
No. So, good evening, everyone, and a warm welcome to all of you. I thank each one of you to taking out the time and joining in this session. My name is Saju Kalupuradam, Product Manager Mutual Fund at HDFC Securities. So, as all of you are aware that there are two major events that has happened from now starting February. One is everybody was expecting, what is going to come out of the budget 2026, and then the surprise element was the positive movement of the US-India trade deal. Right now, this has changed the market dynamics altogether. So I'm sure each one of you are very eager to know, how does, where does market goes from here? So, and what are the different emerging investment opportunities for us, right? To help us, to get better idea about the market outlook and the emerging opportunities. Today, we have Shibani Kurian, Equity Fund Manager at Kotak Mahindra Asset Management Company. To give you a background about Shibani ma'am, she has been with Kotak Mahindra Asset Management Company since 2007, and her key responsibility includes fund management, and she's also heading the equity research team. So we have the right person with us to take us through in this session. And prior to Kotak, she has worked with UTI AMC. And about her qualifications, she has done postgraduate diploma in finance and BSc honors in economics. So a warm welcome to you, ma'am. There's a lot happening in the market, and I'm sure that our viewers are looking forward to hear from you. What is there for them?
Yeah,
All yours.
thank you so much, and pleasure being with you and everyone else. So yes, there has been a lot that has been happening in this calendar year. So we started off with a lot of news flow, as well as a lot of factors that will possibly impact our markets. Uh, Before we get into details, let me just share my presentation, and then we can proceed. So just give me a minute. Uh, Yeah, I hope this is visible. Hello, is this visible?
Yes, ma'am. It is. It
Yeah,
is visible.
okay. All right. So once before we get into the nitty-gritties of what's happening in the equity market and the impact of the trade deals across the world, let us just spend a little bit of time on what some of the key provisions are from the budget and what impact it has on the equity markets per se. So I think the focus of this budget was clearly in terms of sustaining an investment-led growth momentum. The all of last year, the focus of policy was in terms of getting consumption back on track. But clearly, this budget talks about capital expenditure with growth in terms of capital expenditure outlined at about 11.5% in FY27. And that for me was the key takeaway from this budget perspective. Now, in terms of fiscal consolidation, the fiscal consolidation roadmap remains intact, and therefore we are looking at a fiscal deficit of 4.3% of GDP in FY27. Now, remember from this budget onwards, the target of fiscal policy will be to reduce public debt to GDP with the aim of reaching 50% by FY31. And therefore, the pace of fiscal consolidation, as you can see in the chart, has been now coming down. And that means that there is more fiscal impetus that is available from the budget perspective to the economy. And overall, if you look at India's debt to GDP as compared to some of the other larger countries in the world, we are still in a fairly comfortable position. The quality of expenditure, more importantly, as I was pointing out, continues to grow. So if you look at FY27, while your growth in revenue expenditure is curtailed at 7%, the capital expenditure growth at 11.5% is clearly what is shifting or tilting the focus in terms of public capex and overall spend. And within that, defense is projected to grow at about 18%. And the government is also giving loans to states to help them improve in terms of their own trajectory on capex. Now, the other factor that the market has been kind of focusing on, and especially in terms of yields, is what the government projected in terms of its borrowing numbers. So if you look at this chart, what it shows you is two things. One, the gross market borrowing projected for FY27 is higher as compared to FY26. However, the net market borrowing as compared to FY27 is the same. Now, the bond market or the debt market is actually focusing on the gross number, saying that the issuances during the year will be high, which is why you have seen the increase in yields. However, our view is that at the net level, the borrowing remains unchanged. And importantly, it is very likely that the amount of money collected through small saving schemes possibly exceeds the budgeted numbers for both FY26 and FY27. So this is something that we will have to wait and watch for. But as we saw in RBI's policy today, the governor clearly spoke about giving adequate liquidity to the market, and I think that is what is going to be the key going forward. Now, apart from that, from a sectoral impact perspective, as I said, the most important outcome of the budget was the impact in terms of continued spend on capital expenditure, and therefore sectors such as capital goods, cement, um, and all allied sectors, which includes infrastructure, real estate, power, etc., are positively impacted because of the budget. The banking sector impact is slightly negative because the bond yields have moved up. But as we come and move along in the rest of the presentation, we'll see that overall for the sector, a lot is changing. And therefore, while the budget from a perspective of yields is negative, but overall view on the sector remains positive. Now, with this backdrop, let's move on to what's happening. Okay, with this backdrop, let's look on to what's happening in the market as well as India's macro position. Now, one, of course, as you know, India continues to be the fourth largest economy of the world and is one of the fastest growing large economies. Now, while the numbers in terms of projections for next year, which is next financial year on GDP growth, are slightly lower, even if you look at RBI's numbers or the government projections. However, the pace of growth continues to remain strong, and therefore it is expected that even in FY27, India would remain among the fastest growing economies. Now, the more important fact is that all of FY26 and going into FY27, there has been a significant focus in terms of consumption. So, as you know, in FY26, which is the last financial year, the budget actually outlaid a significant portion because of the income tax relief that was given to below 12 lakh income. And that amounts to almost 0.3% of GDP. Then there was the GST rationalization, plus the cash transfers that took place for women by multiple state governments, and that's an ongoing thing. So taken together, the entire consumption stimulus that was been given is about 1.4% of GDP or $60 billion, which is a large number. Now, going into next year, which is FY27-28, there is also another consumption stimulus that is in the offing, which is the 8th Pay Commission. And almost 40% of formal employment is in the public sector, and therefore the pay revision will impact them positively. And this includes central government employees, state government employees, and public sector employees. And therefore, this is a fairly large stimulus from a consumption perspective. Now, the question comes in the terms of the capex led cycle. Now, between FY21 and 24, there was a sharp increase in terms of capex, especially capex by the center and the state. And therefore, public capex was what was driving the overall capital expenditure and infrastructure and investment growth in India. However, now we believe that capex by center and the states will largely be in line with nominal GDP growth. And as we saw even in the budget, the capital expenditure growth is at about 11.5%, which is slightly ahead of the nominal GDP growth of about 10%. And therefore, a lot of the heavy lifting will now have to be done by the private sector. Now, the corporate capex cycle is gradually improving. However, it's a very gradual improvement. And therefore, if the question is that when will the private capex cycle pick up? So if you look at the private capex cycle, the stage is clearly set because today corporate balance sheets are healthy and leverage at the corporate level is at about a 15-year low. More importantly, banking sector balance sheets are also very healthy with gross and net NPLs being at a decadal low. And overall, at the margin, we are starting to see some uptick as far as capex is concerned at the listed company level. However, the capex in terms of the nature of capex is changing with focus on segments such as electronic manufacturing, semiconductor, renewable energy, and the like. Now, this is the macro backdrop. And of course, one big change that took place was the signing of the free trade agreement, one firstly with Europe, and then the trade deal with the US. Now, one of the factors that has been impacting our markets has been the flow dynamics, especially as far as foreign institutional investors are concerned. And one of the reasons that FIIs have been negative on India, apart from earnings and valuation, was the fact that the currency has been under pressure. However, now with the trade agreements across the world, it is likely that the pressure on the currency abates because your dynamics in terms of trade deficits start to improve. We become extremely competitive in terms of exports with respect to the rest of the emerging market pack, and hence this is a clear positive. Now, when you look at last year, and last calendar year was actually a very, very painful year for Indian equity markets. So, India underperformed hugely in context of the emerging market pack. In terms of dollar returns, our markets were largely flat as compared to the EM pack, which gave almost 30-31% dollar returns. And of course, markets like Mexico, Brazil, and Korea were the best performing EM markets. And therefore, there was a huge underperformance. This underperformance was on the back of three key factors: our earnings growth slowing down and valuations looking expensive on a relative basis. The third factor was, of course, as we discussed, currency and sentiment around what was happening globally, especially where trade is concerned. Now, slowly as we go along the presentation, we'll see that most of these factors are now largely being taken care of, and therefore our outlook for equities from current levels is improving. And our view is that as we go into the remainder of the calendar year, it is likely that we see this as a better year for Indian equities as compared to the last year. Now, again, when we look at the market, and when we look at the headline benchmark actually masks broader market weakness. Now, when I ask anyone, they'll say that yes, markets were largely flat in calendar year 2025. But actually, when you dwell a little deeper, you will see that the drawdown at a stock level is far more than what the index is showing you. So if you look at this chart, the median drawdown from 52-week highs. So for Nifty 500, for example, at a headline level, the benchmark is flat. However, when you look at the median stocks in terms of drawdown from 52-week high, that number is close to 18%. That means the correction has been fairly sharp. Similarly, for the mid cap index, the number is about 15%, and for small caps, it is about 24%. So, therefore, the broader market has been extremely weak and it has been a challenging year for markets. On top of it, we saw that FIIs were net sellers to the tune of more than $18 billion in calendar year 2025. And today, FII holding of Indian equities has continued to fall and it is at a decadal low. And therefore, flows, especially the FII flows, have been negative and impacting markets. While on the other hand, we saw record buying from the domestic institutional investors to the tune of almost $90 billion. So, therefore, while on one hand you saw FIS selling, on the other hand you saw DIS buying, and there was this huge tug of war that took place in 2025. Now, from a sectoral perspective, if you saw, the sector that was sold the most in calendar year 2025 was technology. Now, as you know, that there is this big debate going on as to whether Indian IT loses out from a services construct in this entire AI world. And I think the view that FIIs possibly took is that Indian IT is the biggest loser, and therefore the largest selling that we've seen in 2025 is the IT sector. The top buying was segments such as telecom, oil and gas, and services. And we'll discuss each of the sector dynamics as we go along. Now, what is changing for 2026 and 27 in terms of earnings? The first factor is that earnings we believe is set for a recovery. So between 24, FY 24, 25 and 26, as you can see, earnings trajectory for corporate India clearly was on a downtrend. However, from here on, our belief is that for FY 27, earnings growth should improve. Now we are in the middle of the Q3 FY26 earnings season. So far, numbers have been largely in line with estimates. And if you look at Nifty earnings is close to about 7-8% on a YOY basis. However, when you look at the broader market, earnings have been slightly better, closer to double digits. And Nifty earnings X of financials is also closer to double digits. And therefore, our view is that going into even next quarter, you should start seeing improvement in terms of corporate earnings. And for FY27, corporate earnings should recover closer to mid-teens for Nifty and even for the broader markets. Now, the most important fact is that this earnings recovery in FY27 is likely to be broad-based. Now, as I was mentioning earlier, one of the large sectors dragging down earnings is the banking space. Banks, as you know, have a very high weightage as far as the index is concerned, and therefore the banking sector earnings being flat in FY26 is clearly impacting the overall earnings trajectory for for the year. However, we believe that from here on, banking sector earnings should improve. We are starting to see signs of pickup as far as credit is concerned, and therefore loan growth for the system is improving. More importantly, now looks like that the rate cut cycle is possibly come to an end or is close to an end. Today, of course, rates were maintained and there was status quo. And that bodes well for the net interest margins for banks because as the rates fall, banks have to reprice loans lower and therefore your margins take a hit. But now you're starting to see improvement as far as margins are concerned. So the core earnings trajectory for banks should improve from here on, and that's one large contributor to the earnings segment. Apart from banks, consumer discretionary and autos should see improvement as far as earnings are concerned. Then you have segments such as healthcare, chemicals, even metals and mining. All of that shows improvement in earnings in FY27. So banks, consumer discretionary, cyclicals, these three sectors should lead earnings going into FY27. Now, more important factor is that the upgrade to downgrade ratio trend is improving at the margin. Upgrade to downgrade means that what is the percentage of stocks which are seeing earnings upgrades vis-a-vis the percentage of stocks seeing earnings downgrades. If higher number of stocks sees earnings downgrades, then there is a decline as far as the ratio is concerned. But now, as you can see in the chart, that the pace of earnings upgrades are slightly improving and therefore the trend seems to be somewhat stabilizing. And that bodes well from the earnings perspective as far as markets are concerned. More importantly, if you look at market earnings in context of peer group, in context of the rest of the emerging market pack, the expectation of earnings in FY27 are now in line with the emerging market peers. Remember, last 2 years, we saw India perform worse than emerging markets as far as corporate earnings are concerned. And now there is a sharp catch up. And therefore, we are now looking fairly okay in terms of the peer group on the earnings front. Now, where are we in terms of valuations? So, if you look at the light blue line, which is the Nifty PE on a 1 year forward basis, Nifty PE is now in line with long-term average multiples. And therefore, for Nifty, valuations are fairly reasonable and risk reward is in favor. And as we were discussing, earnings should improve. When you look at the mid-cap segment and you look at long-term average valuations, the mid-cap still trade at about 10 to 15% premium to its long-term average multiples. However, for mid-caps as a segment, the earnings growth has been fairly strong even in the last few quarters. And therefore, for mid-caps, there is clearly an opportunity to look at stocks where earnings delivery is strong and valuations are reasonable. And hence, bottom up, there are opportunities as far as mid-caps go. Now, for small caps, the valuations are still elevated. For small caps, if you look at vis-a-vis its own history, valuations are at about a 30% premium to history. And here, the quality and delivery of earnings has been poor. This quarter, however, small caps have seen improvement in earnings, but remember it comes off a very low base because the same quarter last year saw small caps deliver negative earnings, and on that base, you're seeing an improvement. And hence, to turn constructive or positive on small caps, we would need to see the pace of earnings continue going into the next few quarters as well. And that's when you start getting a little bit more comfortable. But today, valuations are clearly stretched as far as small caps are concerned. Now, in terms of relative performance and relative valuations. As far as the EM pack is concerned, the average valuations, India typically trades at a premium to the EM pack. And post the underperformance, what we have seen is that the premium at which India is trading at, as compared to the MSCI EM valuations, that is now down to long-term average levels. So even on a relative basis, our valuations are now looking a lot more reasonable. We are not super cheap, but we are not super expensive as well. Now, because of the outperformance of India in terms of the last couple of years, especially between 2022 and 24, our valuation premium had gone up considerably. And as a result of which, what we saw is that relative basis and in absolute terms, India's valuations were looking stretched. And therefore, when earnings started to come off, we saw this underperformance because FIIs turned net sellers. Now, both the earnings factor as well as the valuation factor are getting addressed. And as we also discussed from a sentiment perspective, the trade deals that have been signed with various large economies of the world means that India's competitive positioning as far as exports go starts to improve. And that also has a bearing in terms of currency and the current account deficit. So, with that in mind, what we are really saying is that we should use every correction in the market as an opportunity to add. Our view is that CY26 should be a better year from an equity perspective than CY25. However, earnings delivery is going to be an important factor, and markets will largely track earnings growth. And in that context, when we look at where we should be placed from a market perspective, our view is that large cap and mid caps are better placed as compared to small caps. We are still underweight on small caps from an asset allocation perspective, and we will wait for earnings delivery to be sustainable over the next few quarters for us to review our view on small caps. As far as mid caps are concerned, there is clearly bottom up opportunities in segments where earnings delivery has been holding up and where valuations are reasonable. However, when we look at markets, we also need to moderate our return expectations in line with the earnings delivery. Now, the last 4 5 years, especially from 2020 to 24 as a period, were great years for the equity markets. And therefore, that period should not be the barometer for return expectations. So, between 2020 and 2025, if you look at BSC 500, the returns were close to 16%. However, when you look at it from a longer term period of 20 years, those returns tend to be a little bit more moderate, closer to 12%. And if you look at the period between December '05 and Jan 2020, which is pre-COVID, the returns were about 11%. And therefore, we will urge every investor to look at markets from a longer term perspective and moderate return expectations and not be uh, more swayed by what happened in the period between 2020 and 2024. Now, with that, the four key investment themes that we are positive on, especially in the construct of what is happening both in our economy as well as globally. One is financial services, where we discussed that there was improvement in terms of growth and profitability, and here valuations are reasonable. So, banks is something that we are positive on, and parts of capital markets, which includes asset management companies, distributors, as well as exchanges. Consumption cycle is clearly gaining momentum, and our view is that discretionary consumption, including autos, are well placed because of the policy stimulus, as we discussed, which should lead to improvement in demand, especially at the mass and affordable levels. The third investment theme that we are positive on for the year is healthcare. And here we are talking about hospitals and diagnostics. We believe that as per capita income increases, there is a shift towards the organized space in terms of better quality healthcare. Our population is such where, on one hand, we have a young population, but there is also an aging population which requires quality healthcare. And also, if you look at the opportunity set which is there in terms of the hospitals, especially on the listed space, we think that the opportunity set is large with the ability to scale up. And finally, the fourth theme we are positive on is e-commerce. And here we are positive on certain segments of e-commerce. This is an offshoot of the discretionary consumption argument that we have. And within the e-commerce space, we continue to be positive as far as the quick commerce segment is concerned. So therefore, these are the four key investment themes that we have for us in terms of sectors that we are positive as far as 2026 is concerned. And before I stop, I must also caution you that there are risks that we must be aware of. One big risk is geopolitical in nature, and therefore, if there is any kind of geopolitical tension or any kind of war that erupts, especially as far as the Middle East is concerned, then all bets are off the table. And therefore, our market dynamics have many moving parts. And as you must have already seen in the last week or so, that there are so many moving parts in the market that one needs to be very disciplined in terms of our approach to investments. Look at companies where earnings delivery is strong and where valuations are reasonable and not stretched. And therefore, that philosophy typically holds good in terms of even when markets are volatile. So I'll stop here and then we'll be happy to take any questions. Hello?
Sure, ma'am.
Yeah.
Sure, ma'am. Dear participants, you can click on the question mark icon and post your questions over there. So while we get the questions, ma'am, any view on gold and silver because commodities?
Yes. So our view on gold and silver continues to be positive. See, of course, when markets, in any market, including commodity markets, you see a sharp up move, then you should be prepared for volatility. And of course, like we said, in case of equity, every year cannot give you the same returns, and that is true even for gold and silver. And therefore, that is something that one needs to keep in mind, especially in the current context. However, structurally, when you look at gold, there is a structural fundamental reason as to why gold prices have moved up and why our view on gold is positive. Number one, of course, the demand for gold globally has gone up. There is considerable central bank buying of gold, and this apart from the fact that gold is usually a hedge in terms of uncertainties and global volatility, there is a definite strong demand which is fundamental as far as gold is concerned. On the supply side, there is, of course, a constraint because gold mining, and there is a constraint in terms of how much gold can be mined. And as a result of which, demand supply dynamics are clearly in favor of demand. As far as silver goes, silver typically is a tends to track gold, and therefore there is a relationship in terms of price movement between silver and gold. However, in case of silver, while the demand for silver, especially industrial demand, has gone up, remember silver from a supply side is not as constrained as gold. However, both the commodities have seen improvement in terms of demand. So our long-term view on the segment remains positive. Near term, of course, there will be volatility given this sharp up move that you have seen. The other thing to watch out for as far as both these commodities go is the dollar. Now, all of last year, the dollar typically weakened against emerging market currencies. And if the dollar weakness continues, this is positive for commodities, including precious metals. However, if the dollar were to strengthen, then you will possibly see some impact because, as I mentioned, there is a correlation between commodity prices and dollar. Now, the view is that globally, central banks, except for the Fed, will possibly be at the fag end of the rate cut cycle. While with the Fed, it is likely that the rate cut cycle continues. And of course, there will be a new Fed governor in a few months. So we'll have to see what the Federal Reserve does. But if the Federal Reserve continues on rate cut cycle, then it is likely that the dollar weakness continues. However, if the rate cut cycle stops or reverses, then the dollar strength will possibly come back on track. So there are moving parts to this, but net net our view continues to be positive.
Sure. So, so since the on this budget, government has introduced additional charges on specifically on the derivative side, do
Hmm.
you see any impact on the market or any particular fund category
Yeah, so there have been increase in taxes as far as
impact into this?
sorry, I didn't get your question fully. Could you repeat it?
Sure. So, my question is that since on this budget, the STT charges have been increased, so
Hmm.
do you see any of uh, the impact on the market and secondly on any particular fund category
Yeah.
in mutual fund?
Yeah. So yes. So the STT, as you know, has been increased for both futures and options. The increase in futures is higher than in case of options. However, when you look at the trajectory of increase in STT, it started, this is not the first year, it started in 2023. Then there was an increase in 2024, 25, there was no increase, and then 26, we saw an increase. Between 2023 and 26, despite these three hikes in STT, we've seen volumes for futures and option actually go up. So therefore, our view is that while there may be a short-term impact, overall volume should remain largely unchanged. Also, where retail participation is concerned, which is more on the option side, the increase has not been as much. And therefore, it is likely that while near term there may be some volatility, over a period of time, volume should be fine. Now, in terms of fund category, of course, there is a lot of talk about how it impacts the return profile as far as arbitrage funds are concerned. Now, what we've seen is everything else remaining constant. It is likely that given the way the arbitrage funds move as far as hedging goes, and also whatever churn they do in their portfolio, the impact on returns could be in the range of about 30 to 35 basis points, assuming nothing else changes. However, remember they do have the option of looking at higher yielding instruments and also reducing the hedging portion as far as the overall book is concerned, and that can help mitigate some of this impact. But we'll have to wait and see how it really pans out over a period of time. So prima facie, nothing else changes. There is some impact as far as arbitrage funds are concerned to the extent of maybe 30 to 35 basis points. But as I said, there are also ability to mitigate this, and therefore the actual impact may turn out to be much lower. But we'll have to wait and see how it happens over the course of the next few months.
Sure, ma'am. Uh, so you have already shared with us the sectors that you are positive on. I would also like to know what is the view on the service sector post this budget?
So the budget, of course, and as I mentioned that not just this year, but over the last couple of years, I think there has been a shift in terms of policy to get consumption back on track as far as the bottom of the pyramid and affordable consumption is concerned. And this has a flow through in terms of how the service sector growth is likely to be. Now, remember, services as a sector is one of the largest components of our GDP. So if you look at the proportion of services in GDP or gross value add as is calculated, that share is close to 55%. And therefore, services is clearly what is the backbone of our economy. Now, the growth in services has clearly been faster than growth in segments such as industry and agriculture. So the share of services in GDP was close to about 50% a few years back, and that has grown to 55%, which means that the incremental market share shift is an outcome of higher growth. Now, when we talk about services, it's not just one or two sectors, it's a wide variety of sectors. So it includes things like financial services, it includes consumer services, it includes technology, it includes telecom, healthcare, it includes power, oil and gas, and the like. So it's a fairly wide and diverse set of services. Now, more importantly, when you look at services as a segment, typically, and there is a Nifty Services Index, as you look at the past data, and of course, past is not a representation of future, but over the last 15-20 years, services as a segment has performed better or slightly better than the Nifty 50. In fact, if you look at the last 16 calendar years, in those calendar year on a yearly basis, services as a segment has outperformed the Nifty 9 out of the 16 times. However, last year there has been slight underperformance, which means today valuations as far as the sector goes or as the theme goes are fairly reasonable. And most importantly, if you look at the theme, the companies that constitute the services sector index typically have a high return on equity as compared to the Nifty, which means that these are good quality companies with good return ratio profile, and the margins of these companies at a PAT level are also better than the Nifty. So therefore, they are more profitable as well. So I think it's a very wide sector, wide theme, and it's clearly one of the growth drivers of the economy. And therefore, the underlying trends are likely to remain strong. Valuations are in your favor, and also these are good quality companies with focus on return ratio profile as well as margins.
Sure, ma'am. The next question that we have is, and this is on, with regards to FIIs. What is that one point that you see that would trigger the FIIs to start, come back to the Indian equity market because they have been a net seller, since last 1.5 year.
I wish I knew what is the one point. But as I said, the reasons why FIIs have been selling India have been threefold. Earnings growth not being there, valuations looking expensive, and of course, the uncertainty in the context of trade and tariff. Now, if you look at all these points, while the earnings trajectory has not sharply improved in this quarter, the trajectory of improvement is possibly here to stay. If you look at this quarter, which is the Q3, the pace of earnings downgrades of estimates has clearly come off. So there have not been any major downgrades. And at a broader market, you are seeing improvement in earnings trajectory. And that we believe will continue into Q4 and going into next financial year. So earnings should definitely catch up with the emerging markets. The second is valuations. Now, in terms of valuations, we are not super cheap, but we are not super expensive anymore. Valuations have become a lot more reasonable. And therefore, for an FII who's looking at earnings and valuations as a combination, which is what typically investors do, both the earnings and valuations in terms of where they were last year and where they are today are significantly better. India has clearly underperformed the EM pack. So from that perspective, it's likely that if the money continues to flow into emerging markets, India would possibly start seeing a better share. And more importantly, I think the confusion or uncertainty relating to trade and tariff seems to be coming to an end, with India having signed an FTA with UK, Europe, and now the trade deal with the US, which should culminate and fructify, and we'll get to know more details over the next month or so. And then, of course, some of the smaller trade deals. Now, what this clearly means is that the pressure on the currency that we saw in the last few months should also start to kind of come down. It's not that we expect the currency to appreciate in a big way, but the pressure in terms of depreciation should come down. And over a period of time, export growth should help in terms of managing the current account deficit. So I think the stage is pretty much set. But we'll, of course, have to wait and see when they turn net buyers in a big way. As long as the pace of selling starts to abate, that itself provides support to the market. As I said, last year there was almost 18, $19 billion of FII selling. And even in the month of January, we saw very sharp FII selling, which impacted our markets. So I think if the pace of selling itself abates, that itself is a good news. And then we'll have to wait and see when they come back.
Sure, ma'am. We picked the last question for this session. Uh, we would like to know that, see, there are three things. One is the US deal that is going on. Then, uh, the second is the geopolitical condition, right? Anytime anything can happen. And
Yeah,
then the third is the earning season, you know,
yeah.
uh, the upcoming earning season. So what do you think will impact the market in a negative way? Probably say, even if the US deal does not go through, if it is not in our favor, but we have a good earning season, then the market might probably, still cover up. But do you think that if, it is the earning, if we are not up to the earning expectation, then it is going to hamper the market big way? So what is your view on that?
Yeah, absolutely. So if earnings delivery falls short and earnings are not in line with expectations, and as we were discussing now, even consensus is looking at mid-teens earnings growth for FY27. So if earnings delivery falls short, I think markets are going to be disappointed. And remember, in the context of valuations, we are reasonable, but we are not super cheap. So therefore, earnings delivery becomes extremely important. And our view is that typically markets will track earnings growth. So the first and foremost is earnings delivery. The second, of course, is what you were, alluding to on the trade deal side. Now that the deal has been announced, it is very likely that it will finally go through, and the final details will be known over the next maybe month or so. And therefore, I would assign a lower probability of the deal not happening. It has actually happened, and since it's been announced, it's pretty much there. It's just that the final contours and the signing possibly is what is remaining. So I think that is lesser of a worry at this point in time. The two key risks, as we were discussing, one is earnings, and therefore, if earnings don't come through, there is a problem. The second is globally, if there is a geopolitical tension or a war somewhere in especially the Middle East, given what's happening today, then again there is an impact. Now remember, typically the way it has worked and all of last year is that dollar has weakened and there have been flows which have come into emerging markets. And of course, India has been on the losing side because of the three reasons that we spoke about: high valuations, earnings, and uncertainty on risk. Now, as long as the flows continue to come from DM to EM, which is developed market to EM, India should get its share. And more importantly, today, if you look at FIIs, FIIs are significantly underweight India. And therefore, if the earnings delivery comes through, geopolitical tensions remain at bay, then I think we are set for a better year and you should start seeing some of that FII flow come back. However, if there is geopolitical tension and there is a war somewhere in the world, then I think again money will move back into the developed markets or money will move out of equity. So I think the biggest two risks, in my view, will be earnings delivery, which is more India centric, and secondly, the geopolitical climate globally.
Sure, ma'am. Uh, uh, so we have a lot of retail investors, those who have joined in, and they are doing, they are participating in the market through SIPs. So, what would be, what would you suggest them, in this kind of a market situation where wherein there is so much of an uncertainties?
So, of course, as I said, that from an equity perspective, our view is that investors possibly should use market corrections to add to their equity positions, be more focused as far as large caps are concerned and mid caps are concerned, slightly underweight on small caps. SIPs, as you mentioned, are the best way to go forward. However, if you're looking at lump sum allocation, then look at a multi-asset product where you are essentially leaving the asset allocation to the fund manager. So if it's only debt and equity that you want to allocate to, then balanced advantage kind of funds. If you want to have a flavor in terms of commodities or overseas exposure, then a multi-asset kind of a product is the best way to go forth. But in terms of asset allocation, the portfolio tilt should be more large and mid and still underweight on small caps. And of course, when you're looking at equity as an investment class, one has to have a long-term horizon and therefore focus on your asset allocation and strategy risk profile as well as your return expectations. And finally, as I said, you need to moderate your return expectations from equity markets in line with the long-term trends rather than use the last 4 years as the barometer of your return expectation.
Thank you so much, ma'am. It was pleasure having you. I am sure all the participants those who have joined in are investors. And the best way, to continue their investments at in this kind of a situation. So once again, thank you, ma'am, for joining in, taking out the time, and addressing our investors. With this, we can conclude. Any last thought of yours before we conclude the call?
One, thank you so much for having me. It was a pleasure being here. So the last thoughts is, as we were discussing, I think from a policy perspective, the stage is fairly well set. So we've had supportive fiscal policy as well as monetary policy. And as we are seeing signs of improvement as far as corporate earnings are concerned, 2026 calendar year hopefully should be a better year for equity markets. However, there are a lot of moving parts as far as markets are concerned. So volatility is something that one cannot wish away, and hence near-term volatility is something that we will have to navigate. So keep the faith and stay invested. Thank you.
Thank you, ma'am. Thank you so much. Thank you, everyone, for joining in this call. Uh,
Thank you.
we conclude this call with this.
Thank you.